I need you to stop scrolling and listen carefully because this is not hype, this is not speculation, and this is not optional. What I'm about to explain is going to affect every single person who owns crypto, XRP, Bitcoin, Ethereum, NFTs, stablecoins. It does not matter what you hold. Starting January 1st, a new reporting requirement kicks in that is based on everything you did in 2025, and most people are completely unprepared for it. This is one of those moments where the damage doesn't happen in real time. The damage shows up later, quietly, when people open a document and realize they owe far more money than they ever expected. And by the time most people realize what went wrong, it's already too late. The issue is a brand new IRS form called 1099-DA. This is not a rumor. This is not a proposal. This is real. Centralized crypto exchanges are required to issue this form, and here's the part nobody is warning you about. The data on these forms is often wrong. Not slightly wrong, but fundamentally misleading. A lot of people assume if Coinbase or another exchange sends the IRS a form, it must be accurate. That assumption is going to cost people thousands, sometimes tens of thousands of dollars, because the way these exchanges currently track transactions does not properly distinguish between a sale and a transfer. Let me say that again slowly. If you moved crypto from an exchange to a cold wallet, many platforms will treat that movement as a taxable event. That means if you bought an asset at one price, transferred it when the price was higher, the system can flag it as a gain, and even though you never sold anything. That's not a joke. That's how a lot of the current back-end systems work. Now think about the scale of this. Millions of people moving crypto between wallets, years of activity, and suddenly in early 2026, people are going to receive a document saying they made far more money than they actually did. Panic will set in, CPAs will shrug, and the IRS will see a number on paper that doesn't reflect reality. Most people don't realize this yet because it hasn't hit them in the face. But it's coming. And here's another uncomfortable truth. Most tax professionals are not equipped to handle this. Many CPAs, enrolled agents, and off-the-shelf tax software platforms do not understand blockchain transactions at a granular level. They rely on third-party forms. If the form says you made money, they assume it's correct. That's how people end up overpaying taxes, legally, quietly, and permanently. This is not about avoiding taxes. This is about not paying tax on money you never actually earned. Now, here's where this gets dangerous for a lot of people, and I want you to really slow down and listen to this part carefully because this is where most mistakes will happen. The biggest issue with the new 1099-DA isn't that it exists. It's how exchanges are going to report your activity and how blindly most people trust that data. Centralized exchanges like Coinbase, Gemini, Crypto.com, PayPal, Robinhood, all of them are classified as brokers under this rule. That means they are legally required to send transaction data directly to the IRS. And here's the catch. For the 2025 tax year, they are only required to report gross proceeds, not your cost basis. That means the form will show how much crypto you supposedly sold or exchanged, but it will not correctly show what you paid for it. And here's where things get ugly. If you move crypto from an exchange to a cold wallet, many exchanges will classify that movement as a taxable disposal. If the price is higher at the time you moved it than when you bought it, their system can flag that as a gain, even though you never sold anything and never realized profit. This isn't hypothetical. This is already happening inside exchange dashboards right now. So imagine opening your tax documents in early 2026 and seeing a number that says you made 2, 3, or even 5 times more than you actually did. Most people will panic, and most people will do the worst possible thing. They'll hand that document to a CPA who doesn't understand crypto and say, just file this. And that's how people overpay thousands, sometimes tens of thousands, in tax they never owed. Here's another uncomfortable truth. Most CPAs and tax software platforms are completely unprepared for this. H&R Block, TurboTax, generic local accountants. They rely on third-party forms. If a form comes from Coinbase, they assume it's correct. They don't reconcile wallets. They don't adjust for transfers. They don't track cost basis across chains. Crypto breaks the old tax model, and the IRS knows that. This is why the IRS is rolling this out in stages. First, gross proceeds. Then, starting in 2026 tax years, cost basis reporting will be added, but only for assets acquired after 2025 and only if they were held with custodial brokers. Anything before that, that burden falls on you. So if you've been active in crypto for years, moving assets, bridging, swapping, self-custody, DeFi, you are responsible for proving what actually happened. The exchange will not do that for you. The IRS will not assume you're right, and ignorance will not protect you. This is why specialized crypto tax tracking matters, not plug it in and hope it works software, but tools that let you reclassify transfers, reconcile wallets, correct mislabeled disposals, and actually reflect reality. The people who ignore this will learn the hard way. The people who prepare now will avoid the stress entirely. Now, here's the part that should genuinely make you stop and pay attention, because this is where most people are going to get blindsided if they don't understand what's coming. For the 2025 tax year, brokers are not required to report your cost basis. Let that sink in for a second. That means when these 1099 DA forms go out in early 2026, what many of you are going to see is a document showing gross proceeds only. In plain English, it's going to look like you made a fortune even if you didn't. Transfers, wallet movements, consolidations, even internal reshuffling of assets can all be misclassified if the exchange doesn't